And they're like, oh, it's coming at 21. I'm like, we'll never get this deal at 21 million. I know this industry. Like I've been here 15 years. I've been the president. I've been like, I speak on the national stage at the biggest event in this industry. I know this industry. And sure enough, we lost the bid. And then we find out like 2 months later, the bid was within,
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I'm joined today by Jonathan Tuttle, creative problem solver while ethically serving others first, featured on over 48 podcasts, host of the Accredited Investor Podcast, Web3's biggest advocate, having an extensive real estate background, knowledge, and experience that started very early growing up in a real estate family, where his father was a general contractor for over 80 homes, including being selected as a preferred home builder by Inland Real Estate. In addition, learning from his father, who had over 30 house flips, owning multi-family apartment buildings, parcels of land, 3 mobile home parks, as well as owning and managing 2 residential real estate brokerage offices in the suburbs. Jonathan, welcome.
Thanks for having me. I'm excited to be here.
Absolutely. We're excited to have you. Great name, of course. I love it. It's like introducing myself. So perfect. For those who are watching on YouTube, he's in Tulum right now, so that's why there's a gorgeous jungle behind him. But you come from a family of real estate. Before we jump into this, obviously we alluded here in the intro, just kind of give us, a little Reader's Digest version of your upbringing.
Yeah, so I was fortunate enough to be in like an entrepreneur style family. My parents were always adamant about just building stuff from scratch. So I always tell the story, like when I was a kid, I would go door to door knocking, selling flowers, my red wagon. So I take that money to Toys R Us. So my parents always instilled like work ethic, and if you put in hard work, you bring value, you get the rewards you want. And after that, I just really watched my dad do the real estate side of it, from like you mentioned in the bio. And I got into real estate around 30. Actually, I was a little late to the game. I did retail sales in my 20s. I did the long college thing. Took as many time in college like that. We then got into like residential brokering, and then went immediately into commercial within like a year and a half, because I just saw the value of commercial. And that's, as investors, everyone likes the tax advantages, the equity multiples, and I just really saw the value in commercial real estate. And so brokered for a few years, ended up being the president of Midwest for Yale Realty. Then I also went after that. I was kind of like swinging more towards actually acquiring parks. So we had a couple parks, as you mentioned, in the family, but I really saw these 506 coming out, which is when all people aren't familiar. This happened the last like 8-9 years, raising capital. This is all new. And I was brokering. I'm like, wait, I'm seeing some people my age buying hundreds of millions of real estate. Like, how do I do this? And so I switched over to a fund model, from Midwest Park Capital. We have a new raise coming this spring, and it's about to be 50 million. It's going to be catered to like higher net worth, qualified purchasers, multifamily, because they have like multifamily and mobile home parks. We're also going to have family offices kind of catered towards them, mainly because they write really big checks and just a little bit less work. I did my last raise, and it's being mobile home parks, even though it's becoming more popular now, it's like you have to really educate people a lot more than most any other asset class. Like, oh, it sounds great, but I'm not there yet, especially like the big check writers. So adding the multifamily to it and going with a bigger raise, that's been more appealing to like the family offices. So that's kind of where I'm at with real estate right now.
That's awesome. I love it. And so if I understand correctly, your dad was investing in mobile home parks, like you're talking
back in the day. Yeah.
Holy cow. So way before it was cool.
2006, we got our first park. And that's when I knew I wanted to get, like, I was working retail, and like I was saving up, and I ended up being the #1 seller in the country. It was a clothing store called BB. It was like BB, Nordstrom, like Saks, Neiman's. They all paid their, the sales reps, if you're really good, well past 6 figures. And I would save my money to get my first park, and then I got into the second park with him. But yeah, he wished he would have gotten, like, when he had opportunity, when he was brokering in the 80s, he had literally had opportunities in some of these incredible parks, but he didn't get it done either. He took and then in fact, he took a course. Now there's like courses out there and stuff like that. He took like the original mobile home park and mobile home investing course. This is like early 2005. It was like a binder with CD-ROMs. I mean, old school. I still have it actually. So it's kind of funny to see like courses back then. Obviously, you have like ClickFunnels, and course nowadays are huge. Facebook ads into like or YouTube ads into courses, but back then it was like really kind of unheard of. And yeah, I just saw it just made sense. Like when you really look at mobile home parks, even though it's weird, it's not as cool. Now it's getting super competitive because it's a supply and demand, but just the way they work, it's a great industry.
Yeah, absolutely. We've had a few mobile home park operators on the podcast before. Very, very intriguing asset class, along with RV parks and that whole side of things, which, as you mentioned, is starting to take off, right? When institutions are getting into something that it's popular now,
Exactly.
and they're obviously starting to see the value, and sounds like that's what you're pursuing. So the fund is going to be diversified between multifamily and mobile home parks, just the two asset classes?
Just those two, yeah, correct. Yeah.
Okay.
And the reason we're doing that too, because 73% of family offices love Class C or just apartments in general, multifamily. So that makes them pushing them across the border. I learned a lot from my first raise, but that's one of the things they like that. They like 50 million raise. It sounds like a lot. A lot of the mobile home operators for fund operators, so usually 20, 25 million raise. There's literally a lot of like ultra high net worth. They won't invest at anything under 50 because the check they write is too big a portion of the amount. And then they literally have stipulations that says, hey, we will only do 50 or $100 million funds. So it's like, I learned all this stuff. I'm like, even though this is great return, I'm like, no, we have so much money. We just need a place to park it. And so we're kind of tailoring towards that type of audience.
Yeah. So I guess talk about, because primarily like for me, right, I'm more on the retail side, retail investor side, accredited investors. Talk about, what it's like working with the institutions and, what their stipulations are, right? Because they're not necessarily looking for that, 7 to 9% return. And, they're typically, okay with the lower return and different stipulations. So kind of talk about that.
Yeah, you're 100% correct. It's a different, like my first, it's still accredited investors. But like you said, they just want more of a place to park their capital. And it's not like especially most funds, it's like, hey, a 15% IRR, this equity multiple, here's the tax advantages. And the more is better for more the regular credit, like a doctor, lawyer, somebody that makes, 300,000-400,000 a year. They're looking to still magnify it. These are people that, like, for a qualified purchaser, they have at least 5 million liquid. And so when they already have that much, and still 5 million today is not a lot of money when you talk about inflation, but government
it's fascinating how that is the case.
Yeah, I can remember when I first made 6 figures. That 6 figures won't even, unless you're in Mexico, like where I'm at right now, it goes a little bit farther, but they already have the money. So it's just they're in a different place. And so they're looking for more, think of like estate planning, think of like, like the South Dakota Trust and stuff like that, where they're looking for a place to park safe assets that they could park. They've already made their money. They might exit out like a company for 50 or 100 million. They already have that. They're not looking to magnify it that much. They want to just hold on to it for generations.
Okay. So capital preservation is number one on their priority list.
Yep.
Okay.
And then tax benefits. Yep.
Got it. Okay. And so what kind of returns do you provide typically, like for this fund? What are you looking at?
Well, the next one's going to be like, typically here's the thing with the mobile home park. So in the last couple of years, when I was brokering back in the day too, the cap rates were like, it was like a dichotomy of like, hey, we had the highest cap rate, but also we were just really value driven. So you'd have like Reonomy, I don't know if you're familiar with it. It's like a real estate data source, kind of like CoStar. And they were like, mobile home parks have a typically 8-10 cap. And they also have the safest asset class for the last 50 years. Self-storage is number 2. And during economic downturns, they always do really, really well. Even better because when, hey, people in middle class, they have to downsize, and people from apartments have to downsize. Well, the last hope is mobile home parks, because you're typically 1/3 the price of a house or 1/2 the price of an apartment. And so that was like, so once all these, like mentioned before, institutions start seeing this and data start coming out, we have internet, we have just more access to data that we never had before, and more people start catching on to it. You have people like Sam Zell, and then all of a sudden you have Blackstone, some of the big funds Apollo start coming into it about 2015-16. What also fueled that was the Fannie Freddie. They didn't finance much before. You had to go to traditional banks, a local community bank in the middle of like tertiary market with not great terms. Well, Fannie and Freddie, it's called the Duty to Serve Act. So for farmland and mobile home parks, It's the best terms of all loans. So it's usually like decently lower than like a regular loan. Plus, obviously not recourse and all the goodies that come with like those nice loans compared to like a traditional personal guarantee from a local bank. So obviously, the risk averse, institutionals, they look for stuff like that. That's really pushed it in. They got the information and they see that it was really an issue that was fragmented. And if they could compile that, they have a nice offering. And so that's what's really been driving it. So like the cap rates, going back to the initial point, cap rates, like people are like, oh, like you people come into the industry are thinking like, oh, the cap rates are 10. No. Like, even like our two smaller parks, and one of them is like a 3-star. We're gonna sell it probably like 4.55 cap. Like that's the offers we could obviously get. And that would have 4 years ago, 7.5, 8 cap. Like,
yeah, easily.
So I mean, just stuff like that. So expectations, it's like literally with the financing fueling it. Supply and demand is 43,200 parks approximately. There's always like a percentage torn down, and maybe 5 or 10 open a year. And it's usually for some reason Texas loves it because they have the, whatever zoning stipulations allow it, and it's a very business friendly state. But generally, it's always a decreasing supply and an increasing demand. And so the cap rates have really, when all the data is out there, the cap rates are compressed. So you'd always want a 3-point spread historically from the financing. That would get you cash in the 15 to 20s. That's what our parks do, over 20. But for our next raise, we're probably gonna be like a little bit on the front end, and then the back end when we exit out, it's gonna be combined. We're probably gonna do a pref. We're still gonna figure out the numbers because like the financing is so in limbo right now, and it's every time they look at the financing going up. But also the weird thing about it is there's such a supply and demand working against us and for us. It's against us if you're trying to buy, it's for it if you're trying to sell. And so we're not seeing the cap rates increase. So obviously if you have the cap rates aren't increasing with the going with the financing, then you're not going to get as a return. But one thing I have to mention though, mobile home parks do get 15-year depreciation of land improvements. A lot of people don't know this. They're like, oh, you can't do land improvements. Yes, you can. It's a very, you have the 100% cost, depreciation is last year, but I think it goes to 80, 60, 40, 20 for the next 5 years.
Right.
But the land improvements 15 years, and the park owned homes 27.5, and obviously multifamily is 27.5 for depreciation. So we still have the best tax benefits of all real estate. And traditional, commercial real estate is 40 years, obviously, or 39. I forgot which it was, but.
Fascinating. Okay. Wow. I did not know that about the depreciation. I knew land improvements you can depreciate, right? So what is that, like putting concrete pads down and
yeah, fencing, all that stuff. And remember where they sit on? They sit on concrete, and they so like 70% of the park, and then most parks they don't get really big yards. So it's like some parks like 70% of the purchase price. So I've heard of 100%, but usually like 70% is average right off the entire park in the first year.
Interesting. Wow. Fascinating. Okay. And then do you increase rates? So kind of talk about it compared to like an apartment, right? An apartment every year, right? Your rates renew the lease, rates are going up. Kind of talk about that aspect of it, because I know that some can be run differently, right? Sometimes they just rent the pad from you, own the house. Sometimes you own the house. So kind of talk about the different aspects of it.
Sure.
There.
Yeah. So the ways to increase the park value, obviously, like any asset, commercial real estate, is better management, operation efficiencies, increase occupancy, and then obviously raising rents or escalations if you're doing retail. For us, and then this is the dichotomy, what you're seeing right now in the news, because people are like, all these big operators are coming in and raising up the rents. Well, obviously they're paying a 4 cap, whatever like that. But where else can you live, unless you're in Mexico, for $350 a month or $400 a month and still be in a nice area and get the same school, same fire, same police. And here's the kicker. The real estate taxes are usually, like if it's older home from the 70s, 80s, $10 a month, $8 a month. Across the street, like in Illinois, where our park's at, which, Illinois is notorious for really high taxes, they're paying like $3,000 on a $100,000 house.
Jeez.
So they're saving the entire lot rent for the entire year. The neighbor across the street in the house, which had the same school fire, they pay that in just taxes alone. So that's the value of it. And you're literally right across the street. And so that's the kind of thing when people gotta realize. And then you have the national apartment rent. I went up to about 2-bedroom, like $1,900, $2,000. The average mobile home lot rent with utilities, I think, is $550.
Wow.
Right now. And the average single family, I forgot the exact numbers. I think I know it's in the 30s, and the numbers it's kind of come back down a little bit. But where else can you work in a minimum wage job in most states, pay your bills or on Social Security. And then here's another thing. Some people are like, oh, and then you're taking advantage of Social Security. It's called the cost of, it has a cost of living adjustment. So it goes up like this year went up 7%. Inflation's like 8.5 right now, but every year, and obviously depending if you take it out, in your 60s, what age, but every year you get more and more money. And if your lot rent goes up $50 and the government's giving you an extra $250 a month, does not change anything. So people got to realize, like, it's like literally a bargain. You're really, like, and if these get torn down, a lot of times they get replaced with luxury apartments because they cost to build, the construction, or senior assisted living centers, or something that's a lot more expensive. So you really, and then governments aren't allowing new ones. So it's like, that's the biggest economy that people thinking like, oh, you're taking advantage. Like, no, you're helping people. And if you actually take care of the park and respect the people and power wash them, people's units free, you throw an event once, twice a year, you help the people out. If they can't pay it, like, okay, we'll give you a month. You don't give them a fee. You do stuff like that. They know you're taking care of them. Like, you're just being a good landlord and helping people live affordably. So, and then there's the big operators do come in, raise the rents a lot, but they're just trying to acquire, like, we had a bid out in one deal, which I knew the price we should have put in. It was ended up going for, it was like right outside of Auburn. I think it was like 27.5, and I wanted to put in like a 26.5 offer. It was a big park. I forgot, 535 units. I had a partner on it that was a multifamily operator, and we were going to, split it. They were more like, they brought a lot more cash for the down payment. And I was like, we need to be around 27. And they're like, oh, it's coming at 21. I'm like, we'll never get this deal at 21 million. I know this industry. Like, I've been here 15 years. I've been the president. I've been like, I speak on the national stage at the biggest event in this industry. I know this industry. And sure enough, we lost the bid. And then we find out like 2 months later, bid was within, we would have been competitive. We would come back if you say, hey, we're putting best in final. But yeah. So they're basically what's coming down is you have to put in high offers and you have to pick out your numbers later.
Wow, that's crazy.
That's how competitive it is.
Think about.
I
can't. And this is one park.
Yeah, it was a big park. It was right outside Auburn University. So, and the average, here's the cool thing about it: the parents would buy the home, and so and then the homes that we saw for the same, or they actually, if you look right now, the last few years, mobile homes, according to realtor.com, they've actually appreciated more than single family. So they would actually buy the home, and they'd make $5 or $10 over 4 years in the home, and then they just pay the $400 lot rent, which is cheaper than paying a dorm for $1,000 a month. And if they had two kids living in it, it's $200 a month. And who lives in college for $200 a month? And it really had like a basketball court, a racket, game room, big TV, and it was like walking distance everything.
So this is basically student housing just in mobile home park form.
Exactly. It was brilliant. I wish we had won that deal. And it was the second biggest operator that won it, of course. They have like 18 billion in commercial real estate. I think like 6 billion in parks, something like that.
Holy cow. So I was going to ask if for that fund, you were going to go try to find portfolio deals, but it sounds
this was
like
a one-off deal. Yeah. This was like a one-off deal. Yeah.
Okay.
It was like, I'm so connected with a lot of people in the industry. And I ranked #1 for like anything mobile home parks. I know how to do a lot of SEO, but
it is funny
so
how
I get a lot of deal flow that people don't see just from the relationships.
It's funny how when you get into this industry and you're in it, all of a sudden, you realize you're competing with, people, and there is something to that, right? It is, everybody wants to talk about broker relationships. And of course, those are important, right? We want to have broker relationships, direct to seller, of course, but there's something to be said about relationships with other principals. And not a lot of people talk about how many deals trade hands just because of those relationships, right? Maybe you do bring in a broker just to kind of, make things go smoothly, but ultimately it's not the broker who brought you the deal. It's the fact that, the principal knows you can close. So they hit you up first and are like, hey, is this a deal you'd be interested in? Right. And you get first looks because of that relationship and knowing them. And I feel like that's an undervalued, or I guess maybe under talked about part of this industry.
Oh yeah, you gotta and I started off the brokerage, so it's like building those relationships over time. And a lot of times our industry, the average, or in commercial real estate in general, compared to residential, where it's like, I forgot the actual holding time. I think it's between 6 to 10 years. The average person sells homes. I don't quote me on the number, but I know it's in that range. But average commercial real estate, it's usually like late teens, early 20s. So people hold these, and it's like, it's literally somebody's gonna pass away. The kids don't want to take it over, and it's not worth it. It's to put it into like an estate for whatever reason on their behalf. So for the people that own that, it was for them, it was like the daughter, it was like four daughters, and they were going to cash out, and like, you're in Alabama and you're cashing out, like they own it free and clear, like 6 million each. And then they have no bills, and it's super cheap to live out there. So it was worth it for them to sell it.
Fascinating. Wow, that's wild. Yeah, it's crazy to see the mobile home park world getting this competitive.
Oh yeah.
Because like you said, I remember 5 years ago being on like wholesalers lists, and they were trying to sling these things at like 12 caps.
Yeah, that's how crazy it's got. And now I think we have a 5-year run. We kind of knew that before. I think it's a 5-year run. And you're seeing a lot of the mobile home operators also adding in different asset classes. Like, I'm friends with the guys. Some of the guys are doing apartments, some guys are doing parking lots, some are doing self-storage. A lot of them are starting to do self-storage. But self-storage is actually more consolidated. For example here, because when I was brokering, I used to work at Spirit NS. We're the #1 office in the country out of 180. So we had the national coach there. We had a different asset class groups. And I got a really good education, all different type of asset classes, which was really cool. And I remember self-storage was like, at that time was when it really started to jump off. And I was on another guy, like one of the top self-storage podcast guys a couple months, or actually a year ago now, and he was talking about, he's like 5 years ago, that was like the golden era of self-storage. So like everyone's chasing the next asset class. So you'll probably have people like, oh, I want to get in parts, but it's like, it all comes down to business timing. Yes, it's still a great asset class, but you're going to have a hard time competing with people like me or my friends, or other people that have been in it for a long time. And you have to understand the expectations of where the asset class is going. Everyone's chasing the next best yield, and we're all getting compressed down because with 506, Reg Ds, SEC basically allows anybody to pull together investors, and it's a more competitive environment basically. And then now we're probably one of the most competitive asset classes out there because of the supply and demand.
Yeah, I love that you brought that up with all the other asset classes, because you do notice now that all of them have that much competition, and it feels like the next one is short-term rentals. What do you think?
I think so too. I was on one of the guys I was on. I've actually have a podcast called Accredited Investor Podcast. Let me throw that plug out there. And one of the first guys I had on, he was a really smart, like digital marketer, Taylor Welch. I don't know if you're familiar with him, but he was like, what he's doing is like, and I know a couple other people have been talking about this too. They're doing short-term rentals, like even like the Airbnbs here. Like, I don't like the arbitrage of people like, oh, I'm going to rent it from somebody else and arbitrage it out, so I don't have to get the lease. But I think short-term rentals and Airbnbs in the right markets, I think this place right here, they got to be killing it. I looked at the numbers, and I looked at what it costs, and then like I look at the availability. If you do something like that, I mean, that's more for like this one-off investor. But short-term rental, we could develop like a little subdivision and stuff like that, or go in an area where there's like Texas or Tennessee or states where there's a lot of people moving in, and then when they first get there are kind of corporate leases. Like it's gonna be more moving parts, and it's gonna be more turnover because every 3 months or whatever it is. But I think it's a really good asset class to explore, because with anything with real estate, if you could be first to market, what they call it, the technology
early adopter, basically.
Yeah, early adopter to before it gets the early majority.
Right.
It's good. And you can always exit out. It's real estate. Real estate, I mean, it's not liquid until you sell it, but there's always real estate investors. That's the cool thing about real estate.
Yeah. And I think one thing that's intriguing about short-term rentals too is, like you said, when you're in the top markets, you can turn it into a medium or a long-term, right? You have those different avenues that you can switch between, and when you're using data and analytics, those are the pivots that you can make quickly, right? Or, hey, this market's not doing well, let's get out while we can, right? It's really no different than any other asset class in that sense, right? But you do have some difference, and it does feel like, there's still a lot more room to grow there, and the institutions haven't gotten there yet. And that's how that, you can still get in early. But so when it comes to these institutions, are you looking, like for the mobile home parks, are you looking at portfolio deals now? Because I do know that's something that typically intrigues them.
Yeah. And then like ultimately for anybody, a tip is before you get in, combine and pull up your investment and then sell it to an institution. Because like that's kind of that's when you get the highest and best offer for your properties. But yeah, like I've never seen so much deal flow in the last 2 years of parks that have been like just ginormous, like $100 million deals, $50 million deals, $75 million deals. And like that was like never a thing back in the day. Like we had brokers some like $20, $25 million deals, and that was like huge. But now it's like, oh, that's $20 million deal. That's kind of commonplace now. Like it's crazy. Like in Texas, it's like insane. insane. One of my friends brokers down there, and she crushes it. Like she's average deal. Like you can't even get a park under 10 million in Texas. Like, and it could be in the middle of like West Texas.
That's insane.
I mean, the average lot out there, I think it's like 100. I don't know. Quote me, because I haven't looked at the numbers last like month or two because I'm not acquiring out there because it's not it's not worth it for me. But like 120, I think pad, and that national average like 50,000 per pad. So kind of give people expectations and numbers.
Jeez.
Yeah. So a normal size, like a little portfolio is 35, 40, 50 million out there.
Are they still building them out there? I know a lot of states are getting heavy NIMBYism with mobile home parks.
They're doing kind of like the tiny homes. So they'll do like kind of a park infrastructure, the same thing, but with a kind of like tiny home or modular homes. It's like the modular home people, the same manufacturers like Clayton and some of those guys have. They have some like miniature ones that are basically kind of like tiny homes. So like that's kind of how they're working around it. That's what they're really accepting. So they have tiny homes, and then they'll have like a community, like amenity center, like in any apartment building with like, a little pool and whatever, a basketball court or whatever.
So they're not going to call it a mobile home park, but
they're trying to make it more, trying to do that. Or what I think is going to be seen more of, and I've heard a couple people doing this, is doing like luxury retreats or senior housing. They say, hey, it's senior housing with mobile home park. It's got to be that workaround, but like to get like, it's the stipulations for the zoning. A lot of, for example, it's called the grandfather law from like 1893. I think it's basically old laws from voting rights for basically against like slavery. It's like a really terrible law. Like they basically redline people from, voting, but that was like the grandfathered in. And then the certain people have rights to, vote. And that's kind of what the grandfathered in means for parks, or it's legally non-conforming. So they were just grandfathered in, like just got a little permission from the local town to be a mobile home park. So a lot of times you're like acquiring parks, like it's not even, you don't have the regular zoning of like any other asset class. It's kind of
right.
It's not unique. So you have to do like when they do diligence in the parks is a little bit different than any other asset class. I've seen enough of every other asset class, but yeah, it's crazy. But the beauty about the industry though is it does sort of affordable housing. It does help people. And as long as the right people are operating it, that's the key. And I think a lot of the new people, like a lot of my friends are like my age. The newer operators are not like the slumlords. Some of the guys have had these for like 50 years, 40 years, and they was kind of like hands off. And that's where you get the mobile home stigma. But the new operators coming in, power washing, improving the roads, making it beautifying, and be like, hey, this is affordable housing. That's what it is. And the market's going to still be affordable, but we're not going to see it. But we have to if inflation's 8.5% and we had to spend this much for a park and we just put this much in CapEx, we have to raise the rents accordingly. And we pay a bulk of the taxes. You pay $8 a month. We pay the real estate taxes.
Okay. That makes sense. So they just pay. So how is theirs calculated versus how yours is calculated in terms of?
We pay just like land, basically like land. And like they do it just like a regular, it's kind of like they're mostly titled. 45 states, 45 states is titled like a car. And then I should have mentioned it earlier, but yeah, you ideally want parks where it's mostly tenant owns the home, and then you just own a couple and transition over and get them off your hands. I mean, you can make a profit like arm off it. I of course teaching people how to do this. Actually, how to flip mobile homes, called Mobile Home Academy. But ideally, as a park owner, you just want to own the park land. It's basically kind of like land lease.
Got it.
The tenants, you don't get the 27.5. But unless you own the actual unit, but you just want to get off your hands, less management, basically. And then end of the day, it's pride of ownership for them. You have a nice set of rules, regs for them. Like, here's what we expect from you. Because there's some people that, they'll trash a place and they've been in it for like 30 years, and you're like, they take, $5-10 grand to, repair the inside of them.
Yeah. And that's not, that's not just that demographic, right? I mean, you see that in any neighborhood. Right. Yeah. So that's not, and I mean, that's natural, right? You live somewhere for long enough. Eventually you're just like, you know what? I don't even care anymore.
Yeah.
So
a lot of times they'll hand you they'll just say, what do you want for it? They just want to get out. And they know that.
Yeah. So. I was going to say, are they just like, cool, I'll just.
Yeah. What do you need on paper to help you move? Like that's usually because they already know you're going to have to put most of the CapEx and improving the unit to make it livable again. Because it's called the minimal livability for just mobile homes, basically. That's a lot. There's like basically the states I have to have you can't just move people in, and it can't be just like nothing in there.
Yeah, right. Can't be all like run down and
it can't look like was it hoarders? Didn't have a unit like
exactly.
It took like 2 dumpsters. It's crazy.
Wow, that's wild. Well, this has been fascinating. Honestly, I love learning about different asset classes, and it's wild to hear about the institutions getting into it. But like you said, when you look at the data from, and now we have a lot of it, right? We've been through, you have '08, of course, and then we had just the recent COVID, if you want to call it that. I mean, it was a slight little downtick, but when you look at that data and you look at which asset classes really thrived, and really the data that fascinates me the most is they all went down. Who recovered the fastest? Like which one recovered the fastest? And you start to see, right, mobile home parks, self-storage, you really start to get this sort of recession resistant thing going, where it's like, oh wow, okay, these can actually weather this storm. And now you're starting to see the institutions see that as well.
Yeah, there was an article in Forbes that said these stocks. It was like Sun Communities, Sam Zell, Equity Lifestyle, and I was like, this stock has performed like tech-like returns 4,100%. It was in Forbes like 2 years ago. Or Forbes, actually Wall Street Journal. I'm sorry, Wall Street Journal, and it was talking about during the last recession, mobile home parks outperformed, and then you have Green Sheet data with institutional data. They do all asset classes, and for the last 8 years, the only thing that was close was self-storage. And then like during the downturn or the COVID, it was crazy. We had like Wells Fargo was actually the biggest lender for mobile homes, and they said had a 54% collection rate during COVID, when apartments were getting like 70% at that time. Because some places people weren't paying, and so they were like blown away by the asset class then. So we really shined in the last like COVID, when people didn't even have to pay realistically. But yeah, and remember, because a lot of times half your audience, 50% approximately are baby boomers, putting the Social Security. So it's the cheapest place to live, and so they appreciate that.
It's awesome. I love it. Cool. Well, let's go ahead and wind down here. We'll jump to the final five. First question: best advice you've gotten from a mentor?
Yes, I would say, man, it's a broad question. I will do. I think, man, best advice. I like this quote. It's like, spend 33% of your time with somebody above you, 33% people your peers, and 33% helping people below you. Because that way you're adding value, learning, and then you're also, you're always moving forward that way.
I love that. That's awesome. I'm going to keep that one for sure. What is about your career that makes you feel like you're fulfilling your why?
I think just when being any entrepreneur, everyone has to start through, from bootstraps, from the ground up, and learning different industries and putting the years of sacrifice and work. And especially me, like just all the people I used to get laughed at when I used to talk about mobile home parks. And now I have less laugh now. But I think just going as an entrepreneur, like just really appreciate your journey. I think I always used to hear that, like Gary Vee to say stuff like that. I'm like, I don't just go right to the top, but like it's the, add value, keep learning, keep proving. And then you see yourself in 5 or 10 years later, you're like, holy crap. I remember that was 5 years ago. I'm like, look where I'm at now. The people that didn't do anything, didn't put the, entrepreneur grind and self-learning, and they're still there. It's like, well, luckily I did that sacrifice. And so I think that's the rewarding factor of being like an entrepreneur.
Absolutely. I love it. That's awesome. Favorite non-real estate or investment related book?
Yes, I used to read like a lot. A couple years I did like 115. I do. Here's a little tip for people: put Scribe app. I know they just raised it like $13, but you could pretty much get 6 to 8 audiobooks. So I put that in while I was doing I do cardio and work out, and average audiobooks 4 to 6 hours without going to speeding up. So if you're doing the gym 1 hour a day, you can get $50 a year. A little pro tip there without even trying. I would say the best business book, or I mean non-real estate, right?
Yeah, non-real estate. So business, self-help, anything like that.
Right now, the last one I read was the story of PayPal, the PayPal Mafia. And so I went through each, the sacrifices and challenges they won. The guys from Illinois, and then you have obviously Elon. But that was pretty cool. It's a long book though. It's like how many hours is this? But it's a long book. But it kind of gave you when they build something from nothing in an industry, that being innovative in industries that nobody perceived happens in the future. And so just really cool perspectives of what they were thinking at that time.
I love it. Yeah, super grateful that there's guys out there who can innovate like that, right? Because, not that by any means am I downplaying this industry, but we don't have to show up and reinvent the wheel, right?
Right.
The playbook is kind of done for us. Whereas these guys are literally riding it, every day. So I love it. If you could have any superpower, what would it be?
Just live long, healthy. I think that'd be the most important.
Absolutely. Cool. And last one, what's the best way for people to get a hold of you and learn more?
Sure. So we're talking about the Midwest Park Capital. It's the mobile home park fund. We're calling it the Affordable Housing Fund, Midwest Park Capital. And also, if there's people that are non-accredited, because I just put accredited, I have a mobile home wealth academy. It's a cool course to teach people how to actually flip mobile homes, but also teach people how to get their first park. I was doing a lot of podcasts last couple of years, and I get a certain percentage of people reaching out. I'm like, well, I'm already there. It's like 23 hours of content. Most courses are like 5. And it has like literally every contract. Then also my podcast, Accredited Investor Podcast, which I interview different people. The cool thing is I do different industries. So it's just, I do tech, blockchain, Web3, real estate, business, just anything in business, basically. So I get different perspectives on there, or just Jonathan Tuttle on social.
Awesome. I love it. We'll link that in the show notes. Make it super easy. Jonathan, thank you so much for your time. Really appreciate it.
Thanks for having me on. It was fun.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.